All right, folks, how we doing? All right, welcome back. Hopefully you had an enjoyable lunch, and hopefully you're able to get into the AMD. We pulled back about a dime from here, and I think we got filled. Right now the market is 37 bid at 42, and we're in at 40. So that's good. Okay, so now this second video that we wanted to put together for today came from some specific questions, both in the room and then also from the foundations room, and it was essentially how do we measure the projected move of a stock for a given time period, and that comes down to some very simple. I mean, it's simple once you know about it, I guess. This, for example, is the Prosper Trading Options trading tool. That's located in the Documents tab, which is the manila-looking folder in the bottom right-hand corner of your Omnovia session, and it'll be, like I said, it'll be under P. Also, we're going to talk about some statistical terms, basically standard deviation and confidence interval. And if you are unsure what a confidence interval is, there's I have something. I think I had. If not, I will post that after this video on what a confidence interval is. It's somewhere in here, but I'll find it again. But what this does is essentially the implied volatility of a given stock for a given time period will allow you to produce a price distribution. You can calculate a standard deviation, or you can customize it to that confidence interval. And so basically, like I said, I will post some material on what the confidence interval is, but think of a standard deviation as a 68% confidence interval, which means, think of a bell curve. 68% of the time, you are going to be plus or minus whatever that standard deviation happens to be underneath that curve. So for example, we just got into AMD, and let's just say that we're trading 23 even. Okay? Now you need three pieces of information. You need what the underlying price is, what your time horizon is, basically what your expiration date is going to be of the options that you're using, and what the implied volatility is at the money for that time to expiration. Okay, so we went out to March 1st in AMD. We said we were trading 23 AMD, or excuse me, the month is 3/1 of 2019, and the implied volatility, depending on what type of platform that you're using, you're usually able to pull some sort of at-the-money implied volatility. For Sterling Vol Trader, which we utilize in Scott and my room, we can get that right here. Essentially, it's right here, every expiration, and then right below it is what the implied volatility is at the money. You can approximate it. If you don't have this, you can look at the strikes that are around that and kind of do some interpolation, but this actually gives you what the exact at-the-money volatility is. And this happened to be 53.1%. It was higher about a half an hour ago when we put this signal out. Okay, so given those three pieces of information, we can get a price distribution. Over here on the left is the full standard deviation move. The standard deviation move is, in dollar terms, is $2.93, which translates into 12.74%. So what this is saying is approximately 60% of the time we are going to be plus or minus 12.74% above and below $23, which translates into $20.07 to the downside and $25.93 to the upside. It doesn't. The implied move doesn't tell you anything about direction. It simply tells you what the magnitude of the expected move is. And the magnitude of the expected move comes from the implied volatility is derived from the price of the options, and the price of the options is derived by simple economics of supply and demand. If somebody thinks that implied volatility is too cheap, they buy the options. If they think it's too expensive, they sell the options, and in the middle is where price discovery happens, and that's what we have as a marketplace. That's why exchanges exist. One of the reasons. Price discovery. And so for this, we're going out to March 1st weeklies. The at the money implied volatility we said was 53-ish. Happens to be 53.9 here on the call side. There's going to be some rounding here, but it's not going to make that big of a difference. And so we see that a mid price of $1.16 yields an implied volatility of somewhere in the neighborhood of 53 to 54%. And from that, we can get that full standard deviation move, or we can do a confidence interval that is more or less aggressive, so more aggressive or more conservative than the full standard deviation move. What I like to use something that I like to use like a 59% confidence interval. Why 59%? It's halfway between a 50% confidence interval and a full standard deviation. It's just it's kind of my rule of thumb. You become comfortable with how things tend to move, and that's what we would use. So we can see that a 59% confidence interval has a more narrow price distribution. Basically, to the upside, we are targeting the 2560 area, and then to the downside, we would be targeting the 2041 area. Now we're looking at an upside play here in AMD. As we can see, there's a couple of reasons. One, we had a pullback to the hull, channel moving up, all those things looking great. Boy. We're going to have to wait on that SMH. We had a day trade possibly come up. Gap fill for those that want to go off on their own, but I'm going to keep this video running. Okay. And then we broke through some significant resistance here at the 100-day moving average, and just the momentum of the space and everything was appealing. And as the market has come off the last few days, quite frankly, I'm looking for something to buy, so we can rally up, and I'll look for something to sell. Okay, so that's the first part. So we figured out that, hey, we want to target this 2560 area, and we could almost go up to 26, but let's just say 2560. So now it becomes a matter of, okay, do the strikes line up? So we already know that we want to trade March 1st options, and so we have half strikes here. So I could target 26 because 2593 was the full standard deviation. I'm going to be a little bit more conservative, and I can't target 2560 like the 59% confidence interval is. I don't know what happened there, but I can target the 25 half. And so that's going to be my short strike. You always want to go to your short strike or more in any sort of debit. So in the case of a debit call spread, you want to go to your short strike or higher. In the case of a debit put spread, you want to go to your short strike or lower. And then it's just a matter of working backwards from that to get the proper reward to risk. So for example, here, the 24-25 half call spread, we put out the signal 30 minutes ago, maybe a little bit more than that, and we put out a 40 bid and we got filled. Okay, so what we can do is we can figure out, again, using the options trading tool, we can figure this out. We can figure out what our reward to risk is. All you do is you put your strikes in here. Here's the 24. Here's the 25 half. I'm long the 24s. I'm short the 25 halves. We know that this is going to have, the worst case scenario is if we are at 24 or lower, because then both the options that we have, one that we own and one that we don't, are both worthless. But no matter what we have to do, we have to pay 40 cents to watch this thing play itself out. So I lose my premium if we go to 24 or if we go to 0. Most I can lose is what I invested in this spread. Now as we go above 24, let's just say we go to 24.01. Well, now I have an option that I'm long that's 1 cent in the money. The option that I'm short is still worthless. So I can make a cent on this spread. I paid 40 cents no matter what. So now instead of losing my entire premium, now I lose 39 cents. Small consolation, but a bit of a win. And this is always going to be values at expiration. The spread can trade essentially whatever price it wants to trade between now. If somebody says I want to pay $1 for this spread, Well, they could. They could do that until the cows come home. But at expiration, there's a truth to expiration. It's either is going to be in the money or it's not. So it's either going to be stock or it's going to be worthless. So our break-even price is going to be our the lower strike here, 24, plus any premium that we pay. So 24.40. Because then we have an option that's worth 40 cents at expiration. This is still worthless. I make 40 cents on my spread. I had to buy a ticket to watch this movie for 40 cents. That's my break even. And I do have this calculated for you here. Debit spread break even. That's down low. It's cheating, but I gave it to you. The maximum this spread can be is at 25.5 or higher, because then it's going to be worth the width of the spread. I have a 24 call that's $1.50 in the money, so that's worth $1.50. This is worthless still at the money, so I can make $1.50 on my spread. I had to pay 40 cents, so I can make $1.10. Max reward divided by max risk gives me $2.75 to 1. 2.75 to 1 on that for max reward to risk. What happens if we go up to 30? Well, we're still good, but we capped our gains out at 25.5. So we still make just the $1.50. We still have to pay the 40 cents. The most we can make is that $1.10, and our maximum reward to risk is 2.75 to 1. All right. So that is a quick overview of that. Hopefully that was helpful. And any questions? I'm not seeing any questions up there. I'm trying to keep this video relatively short so you don't have to sit there for an hour and watch this. But that is how we calculate the expected move. And then I also threw in there at the end how to calculate the reward to risk on a debit spread. All right. Thanks a lot, everybody. I will get this video rendered and out to you as soon as possible.